Good afternoon, everyone. Welcome to our August webinar on liquidity and interest rate risk. My name is George Kodwa, and I will be your moderator for today's event. Before we begin, I have a few administrative announcements. We need you to adjust your computer volume so that you can hear this webinar clearly. If you need to resize your slides, please drag the bottom right corner to do that. Also, from this side, you'll need to enable pop-ups. Please utilize the question function at the bottom left-hand side of your screen when submitting your questions. You can also submit questions via email to webinarquestions@ncua.gov with the subject line, Liquidity and Interest Rate Risk Management. If you'd like a specific panel member to answer your question, state the person to whom your question is directed to in your email. If you have any technical questions about accessing the webinar, you can send an email to audience.support@on24.com. We will address as many of your questions both during the live webinar and after the presentations are completed. We also have a post-webinar survey. We're going to push that out to you once we finish completed the presentation section of our webinar. As always, in approximately 3 weeks, we will close caption this webinar for on-demand viewing. The NCUA will provide live Twitter updates. Our Twitter handle is @the_NCUA. Participants can submit questions over Twitter at any time during the presentation. Our panelists today are Robert Bruneau and John Nilles, Senior Capital Market Specialist with NCUA's Office of Examination and Insurance Capital Markets Division. They will be joined by Charles Valenti, Chief Executive Officer of Del Norte Credit Union of Santa Fe, New Mexico, and Jeremy Ebert, Vice President and Treasurer of Wings Financial Credit Union of Apple Valley, Minnesota. With that, I'll ask Robert to get started.
Thanks, George. Appreciate it. Good afternoon, everyone. John and I would like to thank the Office of Credit Union Resources and Expansion, or commonly known as CURE, for inviting us to participate in this educational event. Additionally, we'd like to extend our appreciation to Chuck and Jeremy for participating in this CURE-sponsored webinar. While John and I will discuss NCUA's approach to evaluating liquidity risk management and the agency's framework for interest rate risk supervision, we believe Chuck and Jeremy's perspectives as practitioners in the credit industry will add valuable insight to our discussions. John will begin our presentation with liquidity, and I will then cover interest rate risk. I'll turn it over to John to get us started.
Thanks, Rob. Hello, everybody. I think what we could first do is start out with a polling question just to get an idea as to our distribution of our participants. So if you see on this screen, select which asset size range best matches or matches your credit union. And we'll just see what the results are.
So let's give them a few seconds to answer the question. Are you 0 to 50 million, 50 to 250 million, 250 million to $1 billion, or greater than $1 billion, or not a credit union at all? You ready? And here we go.
Oh. All right. For those that are... Okay, well, that's interesting because most of our credit unions are way under the 250, so we've got some participations and some folks that are of the larger than what would be a normal distribution. All right. Thanks so much. What we're going to do to start out with in terms of what I think everyone would be more interested in knowing is kind of a review of our perspective of the 2019 supervisory priorities that we issue in January or actually late December of every year. And the three that we had regarding liquidity and interest rate risk, First one was the potential effects of rising rates on the market value of assets that affect changes to net worth and borrowing capacity. Well, as part of where we're coming from as a regulator, this is really all about how it would affect the NEV in the base case in your supervisory test or in your interest rate modeling, because as you know, as interest rates rise, that'll depress the value of assets, and it will potentially have a drop in your base case NEV, especially in the supervisory test. The other potential here that would be affecting liquidity would be as the value of assets that are longer dated are pledged for collateral for additional liquidity. You'll have a little bit of a constraint, maybe 5–10% of those types of assets in terms of you being able to borrow capacity. So one might be just as a cutoff for liquidity a little bit, and the other one might be a resulting in a higher risk rating potentially if there's enough drop in that NEV in the base case. The second one is regarding member preference shifts to shares with more market sensitivity. What we found is over periods of cycles, and remember that these supervisory priorities came out at the end of last year when we were in the midst of somewhat of a panic as a result of the Fed raising rates, having a number of rate increases scheduled for 2019, and since then interest rates have dropped across the curve about, in some cases, even more than 100 basis points. So that is where we were at then. Now, less of a concern if we were to come out with these priorities right now. But where we were at then, we were noticing there are people have a tendency of shifting into money market accounts or accounts that are more rate sensitive as rates move in a sustained and upward trend, which is where they were in January of this year. And what that can happen is that it can obviously affect your net interest margin as rates reprice more aggressively in terms of your cost of funds. And for the most part, as far as from an example, the examiner is going to take a look at your ALM modeling assumptions and find out if your betas that you're using in those deposit rates reflect what reality is. And the other thing is that it's been a long time since we had a suspended move in rate in order to really have a very accurate expectation of what it ought to be for a beta. And what this is really leading towards is that since we don't know what our members' real sensitivity is for change in rate, because we haven't had enough sustained move over the many years, it makes a lot of sense for credit unions to run their ALM models with alternative, or rather a various number of different betas to test to see under different scenarios whether or not your risk limits are in danger of being breached. That goes for both net income and also for NEV sensitivities. The third one was credit union management's ability to meet liquidity needs given the increased competitive pressure that affects share balances. What we noticed at the end of last year was that there was a big increase by larger commercial banks. They were moving their average deposit and their cost of funds up a lot faster than credit unions were. Two reasons for this. One, they're more leveraged and need funds more than your average credit union does. And secondly, they're under required ratio that were from regs that were passed, right after the crisis. So, for example, the liquidity coverage ratio requires them to have at least 30 days of coverage of use, and that they're enforced pretty strictly for the largest accounts. So we were concerned that credit unions were going to be behind the curve and that banks were going to take or be more aggressive in their deposits than maybe what credit unions were expecting. I think at this stage, that's probably less of a question. Part of where we were, for example, when we came out with those supervisory, and we still are concerned because we're still pretty close up here, was the changes in the total of loans to shares, loans to assets. And so here, since Middle of 2013, we've had an upward climb in terms of the financial leverage ratios that credit unions have been under. I don't know if 85 of loans to shares is a high. I can't imagine, I don't remember it ever being higher than that. And so at that point, we're in an environment that a lot of credit unions aren't used to being on average, and some obviously are a lot higher than 85 loan to share, or 71 was the peak in loan to assets on this cycle. So that goes to, well, if we're not used to being in this environment, are you taking steps to adjust and be more mindful of monitoring your liquidity? The next one is that kind of like the mirror image of that is that as you increase your loan to share, loan to assets, well, these monies of your bond portfolios are going to go into loans, and also you're going to use some of your short-term cash up. Here's a drop in cash and cash equivalents, or cash plus short-term investments as a percentage of assets. Those both showed slow declines, probably dropping as much as 50% from where we had a peak during the crisis. Part of, before we have a discussion of what is really liquidity risk, we want to at least have a reference to what our examiner's guide defines it as. And here we have liquidity as a credit union's capacity to meet its cash and collateral obligation at a reasonable cost. Here, like any risk, what are the chances of something happening that will cost you money? And we're not saying it's a risk that is to, bankrupt you, but rather a risk so that is to impair either your capital or your profitability. And the next one of a regulatory expectation in terms of managing that risk, we expect the credit union management to maintain an adequate level of liquidity to provide for both, provide efficiently, meet both expected and unexpected cash flow and collateral needs without affecting its daily operations. And so really then, the question may from that come is, well, what would be maybe a best practice as to how to make sure we meet all of those efficiently? And I guess the answer to that is maybe related to our next polling question.
Go.
So our polling question is, and this is with mindfulness that not everybody does project cash flows using scenarios, because if you don't have a liquidity concern and you have actually too much liquidity, you're probably not going to spend a lot of time analyzing it with different scenarios. So we understand that, and we also understand a lot of our smaller credit unions are more that the case, that they wish they had less liquidity. So does your credit union project cash flows using scenarios, different scenarios, yes or no?
Here we go.
Aha. Looks like a lot of folks are, and in the end, since every credit union is different in terms of how their balance sheet's constructed, how they're assembled in terms of the different drivers that are available to them, or their membership needs, or the type of structure and the type of balance sheets they have, everybody has a different set of cash flow projections, and they're all going to look different. And each of those different types of projections are each going to be unique in terms of being able to measure what a credit union's primary, secondary, and even contingent levels of liquidity remain given different scenarios. Scenarios such as changing how your loan demand would be in a stronger environment, or what would be a particular change in a variable in your projections that would affect maybe breaching a risk limit. So those are the kinds of reasons that we'd want for credit unions especially that are tight on liquidity to run different scenarios, because we all never know what is going to happen. Okay, so as far as speaking of what the regulatory expectations are, back in 2014 we did pass a liquidity rule that after the corporates were affected and were no longer the same type of providers of liquidity, we passed a rule that had requirements for liquidity, requirements regarding liquidity for different asset size types. For example, for credit unions that were under 50 million in assets, we required them to have a written liquidity policy, but also at least provide a list of where they would have contingent sources for liquidity. For greater than 50 million, they'd have that requirement, plus they'd have to develop and maintain a liquidity contingency funding plan. And for those above 250 million, they'd have to have those previous two requirements, plus have an access and backup federal liquidity source, such as CLF or the Federal Reserve discount window. It should be mentioned, too, that, as we see here, Rule 741, 741 is part of our rules that have to do with the requirement for insurance. It's serious enough so that if you don't do these things, it can put your insurance at risk. Interest rate rules and regs and procedures that came out last year are also under 741 in Appendix A. So, I've got one last polling question that we're going to talk about related to as far as how different types of credit unions have different types of business models and differences in how they price their regular and CD rates. So let's, if you could, pick a statement that best matches your credit union. Unfortunately, if you have a type of credit union that doesn't match any of those four, we didn't have room, so I'm afraid you just, going to pick the one that's closest. So, paying above market rates on shares is a major component of the value-added equation to our members. Providing a superior member experience is a higher priority than paying above market rates. Our share certs are directly driven by loan demand, so higher loan demand would be higher share rates, and we borrow externally to fund excess loan demand instead of paying marginally higher rates to our members. Those are the possibilities that we got to work with for right now.
All right, here we go.
Okay, so do we have, interesting, the second one seems to be the most popular, followed by the first one. Providing superior member experience is higher priority than paying above market rates. I just want to mention that in this particular case, that's interesting in the sense that to the degree that it's all about providing a member experience, you're less sensitive to rates because you're not all about rates. And so that has actually profound implication towards how you are affected to changing rates. On the other hand, if you are all about rate, that will affect the level of sensitivity that your members have to change in rates in the market and how you reprice as a percentage of those changes. And what we're going to do is move right in towards having our credit union executives share with us how they deal with their credit union models and how they how their decision process affects how they manage interest rate risk and liquidity risk, and maybe talk about some of the more challenging aspects of maintaining their risk management framework over the years. And are we going with who are we going with first?
Jeremy.
Jeremy Ebert from Wings, if you could.
Sure. Yeah, I'll start first with from a governance perspective. All of our interest rate risk and liquidity measurements and limits are first reviewed in our monthly ELCO meetings, which consists of each of the senior management team members, along with members from accounting, treasury, investments, and loans. The interest rate risk and liquidity analysis then flows up into our finance committee, which consists of a board member and volunteers as well. Additionally, ALM education occurs at ELCO and the finance committee level. Lastly, the interest rate risk and liquidity risk are then presented and reviewed at our quarterly board level meetings. Regarding how we specifically analyze these risks, I guess I can speak first to interest rate risk. We believe it's important to review earnings at risk first, which is more of a short-term view of interest rate risk, and then NEV as well, which is more of a long-term view of interest rate risk, which captures the entire time horizon of cash flows that reside on our balance sheet. We feel that a combination of these two perspectives gives us a comprehensive understanding of our interest rate risk profile. Then lastly, it's also important to mention that we do sensitivity test some of the major assumptions as well, including prepayment speeds and deposit behaviors, that being betas and the decays or weighted average lives of those non-maturing deposits. So with all of that combined, it gives us an even more complete understanding of our interest rate risk profile. Speaking specifically to liquidity risk, we do take more of a liquidity coverage ratio or LCR approach. We do view it from a with and without borrowing capacity perspective. We also do monthly projected cash flows 12 and 24 months out, as well as daily projected cash flows 60 to 90 days out. As a part of the LCR report that we compile here monthly, we do include several stress scenarios as a part of that. For instance, the securities haircuts incrementally increase in each of the scenarios, as well as the potential outflows increasing in each of those scenarios as well. Gives our management more of a complete understanding of where our breaking point might be from a liquidity perspective. We've also established a liquidity and contingency funding plan, which documents our funding sources and action plan in a liquidity stress event. The second part that I can speak to is in regards to what is the most challenging aspect of maintaining our risk management framework and how has it evolved over time. I guess when I thought about answering this, I would say the biggest challenge was that each person across the organization really does have different levels of understanding of interest rate risk and liquidity risk. So at times, the efforts to educate all these different levels has been a challenge. And that includes communicating the concepts of funds transfer pricing to our loan product managers and our branch managers as we mature our channel and product performance program here. It also includes educating everyone on the scenario analysis that we complete in our capital plan, which actually goes above and beyond interest rate risk and includes credit risk, strategic risk, and operational risks as well. In regards to how this has evolved over time, I can't say necessarily that challenge will ever really be over. However, I definitely feel like the understanding of these concepts and how they impact the overall performance of the credit union has definitely improved. We continue to hold monthly meetings on loan and deposit pricing, as well as channel and product performance. And we're definitely seeing progress being made there. Through these meetings and discussions, we've strategized and developed several new loan and deposit products over the past several years, which has helped us grow and serve even more members. And lastly, overall, I guess I look forward to continuing to build upon this foundation in these areas here at Wings.
Great. Thanks, Jeremy.
Yeah.
I think we have Chuck on the line here, Chuck Valenti from Del Norte.
Yes, thank you.
Yeah.
I'll address how we manage liquidity risk first. The way we look at that is we kind of look at loans as the economic engine, and we look at liquidity as the fuel for that engine. And so as we're going 5,000 feet over the ocean towards our strategic objectives or our destination, we need to know, well, do we have enough fuel to get there? Or do we need to change our destination or our strategic objectives? So in order to ascertain whether the little red fuel light is on or off, we first kind of look and see if cash and cash equivalents are less than 6% of deposits. And if they're not, we feel pretty comfortable continuing to cruise. If they are less than 6% of our deposits, we take a quick look and say, okay, are they less than 3%? And if they are less than 3%, we go into management, comes up with a plan to issue back to the ALCO committee on how we're going to be able to modify that situation. And if it's not less than 3% or less than 6%, we then take a look and kind of see if our cash and cash equivalents plus our credit lines are less than 9% of our deposits. And if they are, we start to report monthly to the ALCO and the management committee there. So in terms of interest rate risk, that's a little less intuitive in terms of meeting with the ALCO and trying to educate them on what interest rate risk is. And so occasionally what I'll do is kind of take a very extreme example and say, okay, what would happen if we were 90% loan to share and all of those loans were 30-year fixed rate mortgages? And then we kind of talk a little bit about how the business model, we fund the loans with our deposits. And if we've got a 30-year fixed rate mortgages, and that is 90% of our deposits, then what happens when deposit rates rise? And it's pretty easy for them to conceptualize that, hey, that's not sustainable. If the deposit rates that we have to pay are greater than the mortgage rates, there's really no way out. So just kind of an extreme example just to kind of ground them in what interest rate risk is all about before getting too much into the details. But we do look at net economic value, and we keep our shares at par. We don't have those working. We keep those at par, and we want to stay within the moderate or minimal range. And if it becomes higher, if it's significant or higher, then again, management addresses that at the next ALCO meeting and then reports to the board at the next board meeting. And similar to what Jeremy mentioned, we also take a look at our short-term risk to earnings. We want to have positive earnings in our current financial structure when short-term rates move plus or minus 300 basis points from current rates. And we also take a look at our capital ratio, we want our net worth to remain well capitalized in an 06 rate scenario when short-term rates are 6% and long-term rates are also 6%. We also do model testing and validations annually. We do some scenario planning and some what-if scenarios in terms of, okay, we want to increase, say, our 15-year fixed rate mortgages, and we go through, again, some scenario planning to see if that would work. Some of the areas where we've evolved with our risk management framework, we have adopted an enterprise-wide risk management framework, which I understand, of course, is beyond the scope of this webinar. But we've learned over time that they kind of all tie together. You can't really look at one in isolation. One of the areas that we've matured in is not looking in our rearview mirror, so to speak, as much as looking forward and using the risk triggers and our understanding of risk to, again, achieve our strategic objectives. So in the early days, we would have separate areas that were trying basically to minimize the different risks. In other words, we'd look at our charge-off ratios and so forth and try to get those as low as possible. But with our maturation, we've moved from trying to minimize the different areas to sort of optimizing them, so to speak. So historically, we had a very, very low interest rate risk scenario environment, but we were leaving a lot of money on the table because we were selling a lot of mortgages that we could be booking and generating interest income from those. So in terms of that evolution, we've gone to looking at all the pieces and parts in comprehensively, and then using that to fuel our strategic objectives. So it's basically gone from maybe a backward-looking checkbox, make sure that we're in compliance, to actually looking at it forward and feeling confident that with our models and with our triggers and so forth, that we can move forward with our strategic objectives without having to worry too much about our interest rate risks or liquidity risk. So we're well positioned to make better decisions, again, by relying on some of those models and some of those triggers that I mentioned. So that's kind of how we do it here at Del Norte Credit Union.
Great. Thanks, Chuck. I wanted to close out before I move things over to Rob and talk about how, with all the different things going on in terms of how to evaluate and view liquidity risk, how we look at risk itself and how we would exam for it, some of the factors that go into it. We look at liquidity risk as something that can be affected quite a bit by having added layers of different types of risks that can be on the balance sheet. For example, the amount of on-balance sheet liquidity matters if you don't have a lot of other sources of liquidity available to you. That is, you don't have, a longer-term bond portfolio, or you don't have loans to pledge, you don't have relationships. If you do have all those things, on-balance sheet isn't as important, but it can matter. How much net worth you have or capital makes a difference if, when combined with credit risk that's evolve into credit losses, if you don't have enough capital to support that type of risk, it can affect you in terms of now you may not have enough capital to support the other risks you have on your balance sheet. Leverage in this illustration has to do with how much external borrowing you have and how loaned up you are. And also, too, it can be viewed as an operational leverage. That is, how much your fixed costs are relative to other types of costs you have that are variable, and to how much your break-even point is elevated. That can affect you quite a bit in terms of your net income. And interest rate risk can be a factor, too, maybe over a longer period of time and more gradually, in terms of what Chuck just mentioned, such as if you have too much mismatch over a longer period of time, it can be an erosion to your earnings if you can't reprice your assets fast enough as rates go up and in a sustained manner. I think some of the things that examiners look at more carefully is that obviously if you don't have enough liquidity, and you're fully loaned up, and you don't have enough balance sheet liquidity to cover over a short period of time, that would be one of their concerns. Another one would be if you have a lot of external borrowing or volatile sources, such as non-member shares or home loan, that when combined to fund a higher credit risk portfolio and then can be cut back if your CAMEL is degraded, that can be a concern. Again, if you have too much liquidity, this type of model doesn't apply. But oftentimes, like anything else, it isn't just one of these factors that will really cause the risk. It'll be a combination of those once you're in a constrained position of having enough on balance sheet or enough sources. So from there, I'm going to move it over to Rob, and he's going to go over his review of how NCUA's IRR supervision process works.
Thanks, John. Again, good afternoon, everyone. This portion of the webinar covers, as John mentioned, NCUA's interest rate risk supervisory approach. We'll discuss the general framework, scope, interest rate risk measurements, and the risk thresholds that the agency follows in its interest rate risk reviews. Many of the comments that I'll make during the presentation are largely consistent with what Chuck and Jeremy had mentioned, at least their comments on interest rate risk. Just to, as John did, to kind of level set everyone on what interest rate risk is, this is how our examiner's guide defines interest rate risk. It involves the current and prospective risk to a credit union's capital and earnings from changes in interest rates. For example, changes in interest rates may alter the timing of future cash flows, which affects the value of a credit union's assets, liabilities, and its off-balance sheet items, and therefore the credit union's net economic value, or NEV. From an earnings perspective, a credit union's interest rate sensitive income and expenses could change given a change in interest rates, which affects its net interest income and earnings levels. So hopefully that level set everyone with what we're talking about with interest rate risk. Likely the most comprehensive document that describes the background and specifics of NCUA's interest rate risk supervision is the October 2016 letter to credit unions. The agency's goals for updating the interest rate risk guidance included improving the outright clarity of our guidance, consolidating and unifying an enormous amount of interest rate risk material that we had issued for over more than 10 years, We're trying to reduce the potential inconsistency of examiners' interpretation and implementation of our guidance. And another primary goal was to develop a process that provides a method for NCUA to collect information in a uniform, transparent, and comparable interest rate risk information for the entire credit union industry so that we can better identify and address outlier institutions. Specifically, the interest rate risk review process we implemented in January 2017 incorporated the following changes. We revised our examiner's guide, streamlined procedures for interest rate risk reviews by developing an interest rate risk workbook, streamlined the scope of the exam review procedures, implemented the net economic value supervisory test, or NEV supervisory test, which is a capital at risk measure. We implemented the estimated net economic value tool, or ENT. This is an automated measurement of the NEV supervisory test. And finally, we redefined the risk thresholds we use in the exam process to categorize the supervisory risk rating for interest rate risk. So we'll cover each of these changes next. First, the agency revised the examiner's guide to consolidate and unify the information on interest rate risk it had previously issued. It was reformatted in an electronic format to enhance navigational utility and includes extensive links to other relevant reference materials. It's highly integrated with ARIES, NCUA's examination platform, and includes detail in the public version of the examiner guide, includes detailed procedures of the agency's interest rate risk review process. Several links, including a link to the examiner guide, are included in the October 2016 letter to credit unions. Now, the diagram on this slide represents the streamlined review areas and structure of the interest rate risk workbook. The workbook is designed to assess the essential elements of an effective interest rate risk management program. It contains the key review areas of our interest rate risk examination. The market risk section contains the NEV supervisory test. The exam begins with the market risk review because it determines the risk-based examination steps that follow. A credit union with a high level of risk will require more steps than credit unions that rate low or moderate. Other review areas include earnings at risk, stress testing, measurement systems, and risk management. These areas represent the major elements of how an interest rate risk program is managed. The questions and supervisory expectations outlined in the workbook are entirely consistent with long-standing interagency guidance. The earnings at risk review delves into the credit union's income simulation analysis and is an important complement to the NEV measure. The earnings at risk information also provides insights to the actual structure and timing of cash flows for assets and liabilities and allows the user to get behind what the NEV number conveys and understand when interest rate risk impacts the credit union through its earnings stream. Stress testing, measurement systems, and risk management round out the overall assessment of interest rate. These cover a credit union's risk scenarios, its analytical platform, and the people and process that collectively establish the major pillars of an effective risk management program. Continuing with the streamlining of the interest rate risk review process, the diagram on this slide illustrates how total assets, in conjunction with the results of the NEV supervisory test, determine the number of review steps in the interest rate risk workbook. Based on today's capital levels, risk exposures, and the efficiency and effectiveness of the scoping approach, we typically see a limited interest rate risk review for many, many credit unions. As the diagram indicates, credit unions in the first gray column are less than 100 million, have no required review steps, and use the automatically generated ENT, estimated NEV tool. Credit unions in the second blue column, between 100 million and 500 million, will have a risk-based procedures dependent upon the NEV supervisory test result. And finally, in the far right, the third green column covers credit unions over 500 million. These credit unions receive a full scope review, and because the credit unions in this asset range are over 1 trillion of system assets, they represent a major source of our exposure, and therefore we require that full review. Now on the bottom of the slide, the two green shaded rectangles, the ENT and the NEV supervisory test, those are the two measures we use in our interest rate risk reviews, but they are distinctively different. First, the ENT. As listed on the prior flowchart, ENT is a supervisory test for credit unions less than 100 million. However, as its name suggests, it is an estimate. ENT estimates a credit union's NEV for base case in a plus 300 basis point shock scenarios. It is based on call report data and predefined sensitivities for assets and contractual maturity liabilities. It includes, the estimate includes standard values for non-maturity shares of 1% in base case, that is book to base, 4% in the plus 300 basis point shock scenario, that is base to shock. An important note for ENT uses a credit union's total equity position rather than its net worth level. The ENT assigns a risk classification of low, moderate, high, or extreme for both the post-shock NEV ratio and post-shock sensitivity. ENT serves as the primary guidepost for assigning the overall interest rate risk rating in credit unions less than 100 million, and is typically the examination's final interest rate risk category rating. For credit unions greater than 100 million, examiners use the NEV supervisory test. With the exception of non-maturity shares, examiners use a credit union's internal NEV information as the values or inputs for assets and liability. This is a major difference from ENT. Remember, ENT uses only call report data and prescribed sensitivities to estimate values. The NEV supervisory test is using a credit union's internal NEV data. Additionally, the market risk section of the interest rate risk review workbook directs examiners to verify the reasonableness of the credit union's internal NEV data. Like ENT, the NEV supervisory test uses standardized values for non-maturity shares, 1% in the base case and 4% in the shock scenario. Now, the standardization of the non-maturity shares helps us to ensure that we can obtain results that are comparable across all credit unions and maintain relative consistency so that can rank order risk outcomes to identify potential outliers. The NEV supervisory test results are designated, like ENT, as low, moderate, high, and extreme, and they serve as the primary guidepost for the overall examination's interest rate risk category rating. Lastly, as I previously mentioned, we redefine the thresholds we use in the exam process to categorize the supervisory risk rating for interest rate. We stratify the levels of post-shock NEV ratios and NEV change sensitivities into the ranges presented on this slide. The post-shock NEV ratio shows the absolute level of NEV under shock conditions, while the NEV sensitivity shows the relative change in the NEV from the base case starting point. Both measures apply, so either measure triggers the assigned risk level. You can also note from the table on the slide, we added a risk level category of extreme, and this represents a point at which the high risk exposure is deemed categorically unsafe and unsound. A credit union with an extreme interest rate risk level is considered unacceptable and we need to take appropriate action to de-risk. Now, an important note about the risk thresholds. The thresholds for ENT and the NEV supervisory test are based on our interest rate risk tolerances with consideration to the share insurance fund. Our supervisory risk thresholds for NEV are outside of the average credit union risk levels. We did this so not to impinge upon prudent operating levels and allow for some reasonable degree of volatility during market changes. Now, overall, the vast majority of credit unions' interest rate risk levels, as measured by either ENT or the NEV supervisory test, are routinely in the low and moderate classifications. Only a minority of credit unions' interest rate risk measurement results are classified as high or extreme. These represent outliers. Identifying outliers is a primary goal of NCUA's interest rate risk supervision, so that we allocate specialized resources and more supervision time to higher risk credit unions and considerably less resources to lower risk credit unions. Now I'll turn it back over to George.
Thank you to our panelists. At this time, Catherine Baxter and Ron Good will read out some of the questions that we have received. Please feel free to submit some more questions. We'll use the extra time that we have to answer the questions.
Thanks, George. So please continue to submit your questions. We have a few minutes to entertain the questions. So Ron is going to give the first question. I believe it goes to John. So go ahead, Ron.
Yes, thank you. So, John, the first question is, when running stress testing scenarios in both shocked and non-shocked environments, test for cash flow coverage using a 10%, a 20% runoff in deposits over 6 to 3 months, sorry, it's running long, do you recommend modeling loan growth in those scenarios? And if so, why?
Okay, I'll try and answer this question as the most sensible way I can think of. One of the ways that how you vary your assumptions, it's going to determine based on what are you really trying to solve for. For example, if you put a macro multiple number of scenarios, macro number of variables in a particular scenario, you're going to say, okay, this represents the types of things that happen in an expansive type of environment. It really doesn't matter for any particular one scenario how many of those variables you change and by how much. I think one of the goals that's most useful that we found is that you run enough scenarios with enough changes in those variables to determine at what point your risk limits are breached. So, for example, just changing one or two, or just even one variable, how much does that variable have to change in order for you to go through your risk limits? That way you know where the warning track is and at what point you could get into trouble with a particular risk limits. And it also does, another factor is if you do an individual change to a single variable, you determine how reasonable that risk limit is, whether it's too high or too low. I hope that helps.
Thank you. We also have another question for you, John, and this question is, what are your priorities now with the falling interest rates?
Well, I want to first say that these priorities were from a consensus of a lot of folks inside of Examine Insurance and in the field from the regions. And so I'm just here to communicate what those priorities of the agency were at the time. I would imagine that if this kind of environment remains the same, that interest rate risk and liquidity risk will still be a priority because it is still a basic fundamental risk. It's just that the kinds of risks or how much of a priority it is for us compared to the other risks that are going on will probably be more emphasized.
Very good. Thank you.
Okay. So we have a similar question, and maybe, John, you answered that already. We had one credit union that wanted to know this. They said, we're now in a different environment, and rates are now declining. It's a declining rate scenario. So is it still a priority now?
Well, what still remains a priority is that you have a risk management framework that runs enough different scenarios so that you cover a lot of the different possibilities. I know that in our sensitivity supervisory test, we only have an up scenario. And that was at a time when interest rates were at or near zero. And so we didn't feel as though we wanted to have a supervisory test that included negative rates. Maybe that's still to come. But I think regardless of what kind of environment you are in the moment, you want to be able to run enough scenarios that run enough possibilities so that you know how the different variables or different types of scenarios will affect your safe and sound operation of your credit union.
Thank you very much. And we have another question for you. I'm sorry, this one is for Rob. How much weight to give to NII versus NEV analysis?
I'm assuming that's how much weight NCUA gives those two. I'm going to go with that's what it's asking. Well, our interest rate risk review procedures, there is a driving element to it, and that is the results of the NEV supervisory test. But it's not the only element, and it's important to recognize that. If you go back and think about the way we structured our workbook, there are other components that the examiner is to look at, and that degree at which they look at that depends on the NEV supervisory test. But regardless of the results of the supervisory test, the examiner to some degree has to look at the earnings at risk. And that's important because it may show the timing of when there would be some issues with the interest rate risk level, because it shows the timing of the cash flow, whereas the NEV is showing the long view, as I think Jeremy and Chuck said, is showing the long range. But the earnings simulation could provide some shorter term information that may be helpful. So we look at both, but our exam review procedures are weighted towards the NEV supervisory test results, whether that be ENT or the supervisory test itself.
Very good. Thank you. Before we come back to you, Rob, because we do have a question for you, we did get one for one of our credit unions, and I encourage our audience, if you have questions for either of our two credit union representatives, please send those on. So this question actually is for Jeremy. And Jeremy, the question is, do you use the Basel III LCR ratio? And if so, how do you discount the cash outflows for retail deposits?
Oh, sorry, I was on mute there. Yeah, we use the Basel LCR as kind of our starting point when developing our own, I guess we call it our wings version of the LCR, in regards to how we've decided to model the outflows of retail deposits. We apply 5% of our non-maturing deposits. We say over the next 90 days are going to be considered an outflow in our kind of our base scenario. Then we do increase that percentage to 10% and 15% as well. In regards to maturing CDs, so the Basel ratio is over 30 days. We actually extend that 90 days. So we say all of our CDs maturing in 90 days, a certain percentage of those would also run off. So 5%, 10%, 15%. I think that answers the question.
Yes, I think so. Thank you very much, Jeremy. So now back to you, Rob. The question we have for you is, I'm from a small credit union and just appointed to ALCO. Can you define book versus base value, please?
Sure. Good for you for asking the question since you were just appointed. So book value simply is the value of your assets and liabilities as issued on your financial statements. Base is is doing a process to achieve base. There's a process of taking your book and marking it to market. That you will achieve base. So, for example, if you have an investment that is earning it's 3 years and it's earning 5%, that investment on your books, let's say, it's at par. It's at $100,000. It'll be at a price far greater than par in the base case because it's earning much more than the prevailing rate environment.
Awesome. Thank you. Great. Thank you very much, Rob. So now we're going to go back to John. John, the question is the Federal Home Loan Bank now an accepted source of liquidity?
I'm going to assume that is regarding the backup source to qualify under 741.12. It is not. We did have quite a bit of discussion regarding that as a backup source. It's an excellent secondary source of liquidity, but as far as meeting the reg, because home loan is a market-based driven decider of whether you get liquidity or not, it was not part of the rule that would allow you to use that as a backup per the rule reg requirement.
We have time for one more question.
Okay. All right. We have a question for Jeremy. You ready?
Jeremy, yes. So, Jeremy, this is for you again. Are you looking at the net stable funding ratio?
We've definitely looked at it and considered it. It's certainly not a part of any of our policies that we have established internally, but yeah, it's something we've considered and we'll do so going forward as well.
Okay.
Okay, great. Thank you.
You know, we had a question for Rob that was sent to us yesterday. And the question is there any guidance on how a credit union can best prepare documents, et cetera, for a risk review by an examiner?
So the best way to, I'm going to assume that the individual asking this is from a credit union that's greater than 100 million.
Yep.
And the best way to prepare for the interest rate risk portion of your examination is to go look at that letter from October 2016 that introduced our existing interest rate risk review procedures, and you'll find links to everything we use for our review procedures. And one of those links is in the examiner's guide. There's actually two. One will be the actual interest rate risk workbook we use, a blank copy of it, and then there'll be another file that will say the interest rate risk review procedures. And that is a document that walks through how to complete the interest rate risk review workbook. And so that would probably be the most ideal way for you to prepare for that. It'll give you the areas that we look at and help you prepare documents for each of those 5 or 6 review areas that we include as part of our scope.
Thank you, Rob. I think we have a very last question.
Yes, we have one more question, and this one, Chuck, is for you. Finally, you got a question. And the question is, do you use non-member or brokered deposit funding? If so, what was the purpose for this fund and how did you use it?
Well, the short answer is no, we don't use those for our funding. We haven't been in a position where we've had to rely on those. So we rely on our member funding.
Okay, very good. Well, I think that's all the time we have for our webinar.
Thank you very much. We do have a survey at the end. There's a survey widget. If you take a moment of your time to complete the survey for us, we would appreciate it. This concludes our webinar session for today. We will have our next webinar in October, specifically October 16th, and it will be in collaboration with the Small Business Administration. So please stay tuned for more information. Thank you and have a good afternoon.